Hello and welcome back to The Note. It's the festive season again, so it's time to return to Hindsight Capital LLC. For the uninitiated, Hindsight Capital is a fictitious hedge fund which has the ability to foresee the future. All the trades it made at the beginning of the year are the trades that you would have made with the benefit of hindsight. We do put some limits on it, no leverage, no individual stocks, no trading through the year, but it's still amazing how well you can do any given year if you've got a really clear grasp of the way the economy is going. So, what trades do they make? Let's start off with oil falls, America rules. There's the shale revolution that's been going on for a long time. It was obvious that at a certain point this would push down oil prices and that would plainly benefit the US economy. It happened this year. So, Hindsight shorted Brent crude, which was down 45.7%, and put the proceeds into investing in the S&P 500 stock index, up a bit over 12%. Total results of that trade, 105%. Next, also profiting from oil, it's relocated to Russia. Now, that might seem a somewhat counterintuitive thing to do, but if you denominate yourself in a weak currency, that makes any investment look that much better. And the ruble collapsed this year thanks to sanctions caused by the situation in Ukraine, and thanks again to the fall in the oil price. So, for example, if you had invested in the S&P in ruble terms, you would have made 105% for the year. Looks good, explains why wealthy Russians are taking their capital out of the country. Next, a sectoral bet within US stocks, transports to beat oil drillers. Plainly, if the oil price is going to go down, then that's going to be great for transport companies because of cheaper fuel, and the S&P transports was up 29.7%. It'll be terrible for oil drillers, which fell about 44%. So short drillers, long transports makes you 132%. Next, still on the oil theme, but investing internationally, long oil importers and short oil exporters. It's obvious why you would do that when the oil price is going down. So you short the Russian RTS stock index, down 43.5%, and put the money into the Indian Sensex index, up 28%. India's almost completely dependent on imports for its oil. It was boosted by the popularity of its new Premier Narendra Modi this year, while obviously Russia was hampered by the unpopularity of Vladimir Putin. Put those trades together and you've made 126% or so for the year. Next, moving on from oil, there is the big government strikes back trade. Start off by shorting Bitcoin. Lots of interesting things are happening in Bitcoin, but it was blatantly in a bubble and too expensive at the beginning of the year. And indeed, it's dropped 57% for the year. Put the proceeds into 30-year US Treasuries. Now, that's a surprising trade. People thought that with the Fed removing support for the bond market that US bonds were going to weaken this year, but they didn't bank either on deflationary pressures from around the world or on the institutional pressures which caused a lot of investors to keep buying bonds. The 30-year bond was up 28.8%, so put that trade together and you have made 212% for the year. Well done, Hindsight there. Next, the European deflation trade. During the Eurozone sovereign crisis, or at least the first version of it, it made sense to sell European government bonds because people were worried about default. Now that that risk of default appears to be off the table, or so many think, we move on to the next stage of the crisis where it actually makes sense to buy the bonds because the fear is that the austerity measures will lead to deflation. So choose the economy that started in the weakest position, that is most prone to a slowdown, and you short Portuguese stocks through the PSI 20 index, which was down 25.5% for the year, and go long 10-year Portuguese government bonds, which gained 34% for the year, the best of any European country. Total return on that trade of just over 75%. Next, move on to China and the risk of a hard landing. Everybody knows for a while that China is trying to shift its model, trying to reduce its great apparent overcapacity, the amount of overbuying it's doing of different raw materials as it tries to build itself out. Also, there was a general understanding that if you did see that slowdown come through, then you might well see easier money from the People's Bank of China to try to avert a hard landing. That could easily turn into gains for China's notoriously bubbly stock market. Well, that's exactly what happened. In the case of Hindsight, it shorted Qingdao iron ore, which fell 49.5% for the year, and put the proceeds into the Shanghai Composite Stock Index, which was up about 44% for the year, the best in the world. The total from that trade, 193%. Now, obviously, you can't expect any real funds to do as well as Hindsight Capital, because in the real world, we don't have perfect foresight. You have to hedge against the risk that you might be wrong. But all of these trades do indicate that for those who with a good and correct grasp of the way the economy was going and the preparedness to back that with conviction, it was possible to have a really great year this year, which for the most part hedge funds haven't had.